Thank you everybody for coming. Before we start, I just want to make sure everyone knows this is Merlot. It's not red, it's not maroon, it's Merlot. Thank you for coming. Really excited about tonight. I see a lot of familiar faces, so thank you everyone for coming that I know. And for those of you that I've never met before, I'll give you a quick introduction. My name is Bogie. Actually, Steve Bogie, I go by Bogie, and I've been with Millichap for the past 14 years. I specialize in apartment building sales in the South Bay, Long Beach, 7A corridor, 605 corridor, and parts of Los Angeles. And when I say I mean my team, which is in the back row there. Thanks for coming, guys. We've done, in the last 14 years, close to $400 million in sales and over 320 transactions. So we're very active in the market, and I think all of you guys that are here tonight are all owners in the areas that I work in and that we work in, so thanks for coming. Really excited about the lineup we have tonight, all the way from Chicago. John Sebree is here, who's our National Director for the Millichap National Multi-Housing Group. We've also got Kevin Mansour, who's the managing partner for the Mansour Group, which specializes in triple net deals. And also Robert Hodge, there he is over there, Senior Director for Millichap Capital Corporation, the lending side, and Greg Burns, Senior Vice President of IPX, which is the 1031 Exchange Accommodator. Also want to thank somebody and recognize someone who's not going to be speaking tonight, who's here to help as well. Janine Hook is in the back, and she can just wave for a second. She's with Title, and she is incredible, and she's here to answer any title questions that you guys may have. So after the event, if you guys want to talk to Janine about some title issues or questions, if she doesn't get the answers in about 5 minutes, she'll have them for you by tomorrow. Before we get started, I just want to talk a little bit about the local market. And I think it's pretty safe to say that everyone here recognizes that the apartment market is red hot here in Southern California. And the questions, the answers, or the comments that we get from pretty much every one of you guys when we're talking to you on the phones and meeting with you is, yeah, I would love to sell. I would absolutely love to sell my building at these prices, but what am I going to buy? And that leads us to why we're here at this event. Over the last couple of years, selling your apartment buildings and trading has been difficult, though we've been able to do it. So if you're still looking to trade from an apartment building, whether it's trading up, trading from a tough area to a better area, trading from a bigger building to a better location that might be smaller, it's achievable, and we've been able to accomplish it for our clients successfully. But if you're looking for more options, or you're looking for less management, that's where the triple net lease option comes in. And that's really why we're here tonight. That's why we put this event on, is really to educate you all, inform you on how the process works, from how the triple nets work, how the exchange process works, how the lending works for triple nets, and just get you guys most as educated as we possibly can. So let me just start off with John Sebree. John is, like I said, the National Director of the NMHG, National Multi-Housing Group, for Millichap. He has been, his background has been a major multifamily specialist, spans over 20 years, 17 of which were with Millichap as an agent. As an agent, he developed a strong brokerage practice in Chicago, opened the Indianapolis office, and earned numerous company awards. John's knowledge of all aspects of multifamily analysis, underwriting, and brokerage on a national level bring a unique perspective to our panel. and we're honored to have him here tonight, all the way from Chicago. Thank you.
Thank you.
And he gets that way.
Thank you. There's no way I'm going to be able to stand in one spot. Before I get started, you should know this is a dark charcoal gray. Thank you very much, Bogie. As you mentioned, I walk around and wave my arms a lot, so my apologies for that. But as you mentioned, I'm the National Director of Multifamily, and I spent 20 years as a broker before I, in a moment of weakness, took an executive position. And it's very interesting because in the broker side of it, you really understand the fundamentals. I mean, you live by the fundamentals, and then I take a position where I'm traveling quite a bit. So I'm in LA now. I was in Miami at the beginning of the week. I was in Vegas last week, DC the week before that, New York the week before that. And it gives me a very interesting perspective. You know, it's kind of that not only flying at 30,000 feet, but maybe flying at 10,000 feet over a lot of different markets, and kind of understanding some of the changes and the trends that are taking place in different markets throughout the country. So what I wanted to do today is go through and just touch on some of the metrics, some of the trends that we're following in the marketplace, and share some of those with you. And I am, a lot of the slides are, it's not going to be real linear. I'm going to bounce around a lot. I've got some good facts, but they don't always connect. So you're just going to have to kind of stay with me a little bit. If you've got questions, just yell them out. We're a small enough group that if you have any thoughts or any questions, feel free to go ahead and do that. Do we, by chance, have slides? Okay, imagine a bar chart with a line. Let me talk first about, I'll go ahead and start on the first slide and we'll catch up. I'm going to talk a little bit about, I'm going to start macro, large perspective, and then drill down a little bit more. And so we're going to talk a little bit about jobs and job growth. And it's interesting because this economic trend, this cycle that we're on, has really been fueled by jobs, more than anything else. And I get a kick out of the job growth numbers because before the jobs reports come out every month, you're watching the news, and a couple of days before, they're already talking about, you know, what are the jobs going to be? What are the jobs going to be? And you're watching the business news and everything. And if the job number comes out a little bit higher, they're like, oh, it's going to be fantastic. It's rainbows and puppy dogs for the next, 20 years. And if it comes down a little bit lower, then they for the next 2 days, they're talking about recession, right? The reality is, job growth has been very, very consistent for the past 71 months. Okay, we have had an average of 200,000 jobs per month for the past 71 months. If you take a look at this, we went into the recession, we lost 8.7 million jobs in the recession. We've since then gained 14.8 million new jobs. So we've got 6 million more jobs today than what we had prior to the recession, which is pretty impressive. But there's another side of this. In 2014, we generated about 3.1 million new jobs in that year. That came out to about 260,000 new jobs a month. In 2015, about 2.7 million new jobs. So 220,000 new jobs, or 250,000 new jobs a month. And 2016, we're on track for about 2.1 million new jobs. So it's coming down. It's more like 175, something like that. So what's happening is we're still having good job growth, but it's starting to come down a little bit. Now, we've had 4.9% unemployment rate for the past 18 months, 16 months. And so there's a question of how, are we getting to the point of full employment? What does that mean? And I don't necessarily have answers other than just some of the metrics we're watching and we're starting to follow. And it is possible that as we start moving forward on this, we're going to start seeing wage growth continue to pick up a little bit. And it's also possible that we're going to see these job numbers start to come down a little bit. I think the economy is very strong. I think we're moving in a very good direction. We got a little bit of, we've got a few headwinds, but for the most part, we're doing very, very well. If we look at where these jobs are being generated, one of the positive aspects of it is just the diversity of it.
Health and education services at 2.8%, business professional services 2.7%, leisure and hospitality 2.8%, which a large part of that is my travel budget. Construction 3.1%. So it's it's a very diverse group of areas that are really generating the jobs. And that's a positive aspect. Anytime you have a huge percentage of your jobs coming from one area, that's when you start getting a little bit concerned. As far as job loss, a little bit of manufacturing, not enough to be really concerned. And then obviously you've got the natural resources and mining. And actually, this is a trailing 12-month. A high percentage of that job loss was really in the first 6 months of that 12-month cycle. So we're not losing quite as many now as we were before, but obviously when they turned off the oil spigot, North Dakota, Houston, some of the Gulf states, we really started losing a lot of those jobs. If we break that down, if we look at where the cities are that are generating the jobs and where the most jobs are coming in, Dallas-Fort Worth, 107. Dallas-Fort Worth is just it's on a cycle all of its own. New York, almost 195,000. DC, LA. LA is doing very, very well, and you've got 74,000 new jobs. One of the other things I always look at on this is that next right column to the number, which is the percentage growth. Dallas-Fort Worth at 3.1%. You've got Seattle at 3.5%, Phoenix at 3%, Denver at 3.6%. Those are big numbers. The national average is 1.7. Okay, so those are, that's a substantial amount of job growth. Now, one of the things we're watching in some of these markets is that sustainable? Is that going to continue to go, or is that going to start dropping off a little bit? Because obviously what's happening in a lot of these markets is, as job growth is coming in and is really picking up, so is new construction multifamily, right? So is there going to be a point where we get out over our skis a little bit? On the right-hand side, we see the 10 markets with the least amount of job growth. And some of these are smaller markets, but 6 of the 10 are in the Midwest, which has kind of been typical of this cycle. You've got a couple of them in Texas. Houston, Houston is just Houston's going to be soft for the next couple of years. There's no way around it. But it's an interesting perspective as to what's happening in the economy. So I find this slide very interesting. This is what this does is it's looking at corporate profits on an annual basis. And you can see what happens when we go into the recession, they drop. And then the blue line is fixed income, fixed investment, reinvestment back into the companies, right? So how much are corporations putting back into their company? And how much are they reinvesting for future growth? And what's interesting is generally at this point in the cycle, it's trending up. It's almost, it's kind of keeping up with the corporate profits. We had corporate profits that went up to from 400 billion to up to about 550 billion. It's dropped back down to about 510 billion. But look at the reinvestment. We were at, we were up, 20% when it's coming out. It's a year over year. So it was 20% when we were coming out of the recession, which makes sense. But instead of leveling off, it's really kind of started to drop back down. People are starting to pull back a little bit. Actually, this last year, there was less reinvestment than there had been the previous year. And there's a few reasons for that. I think a lot of the corporations they're just a little bit hesitant. I think the election has a little bit to do with it, right? Everybody's looking at it. Could you imagine, like, if Washington, Lincoln, and Adams came back and saw the 2 people that we had running? That's my nonpartisan slam, by the way. But I think a lot of people are a little bit hesitant about that. They're like, we're not really sure what's going on. Look at the amount of corporations that have reinvested in their stock as well. So they feel good about the company. They just don't necessarily feel good about a huge amount of expansion. I think Obamacare has had an effect on that. A lot of the money that they're making, they're having to now spend on additional health care and on additional just cost for their employees. And there's probably a little bit of a recession hangover. People are very much remembering what it was just a few years ago, and they're thinking, I'm not ready to go build a new plant. I'm not ready to totally retool my existing plant. But this is interesting because this is going to tie in very much with what you hear about kind of a lethargic GDP growth. Next slide. Let's talk about millennials just a little bit. And millennials are very important to the multifamily industry because this is the 20 to 34-year-old age group. And millennials are important because this is our prime renter demographic, right? And millennials, the other good thing is millennials make a lot of money. And they spend a lot of money, and that really keeps the economy going. In fact, many millennials spend more than they make. But the thing to keep in mind about the millennials is that this generation is over the next 5 years is going to grow by about 1.4 million people. Okay, that's a swell. That's pretty. It's a sizable amount, especially when 68% of them are renters, and that's a higher propensity to rent than what previous generations have been. Okay. The other part of it is that the millennials are, and I've said this before, but millennials are actually, that generation is just, from a perspective, is larger than the baby boom generation. Baby boom generation was 75 million, I think millennials are 80 million. So this is something that really over the next few years will continue to provide a little bit of a tailwind in the multifamily industry and in the rental industry. Now, if you go to the next, now, so I said it has a 68% propensity to rent. So obviously what you're thinking is, well, that means 32% of the people are buying homes. No, most of them are living in your spare bedroom. All right? So this is an interesting dynamic in that there was a percentage of young adults living at home, and that percentage was about 26% on average, 25-26% really for an extended period of time. And then we went into the recession, and that increased to about 32%. Now, a couple of years ago, we're looking at this and we're thinking, well, as the economy starts doing better, these people are going to move out of the house, and start moving back into apartments. And we underestimate. Apparently, moms are better cook than we realize, because that number has really stayed at a pretty high level. And I bring this up from the standpoint, it'll be interesting to see over the next couple of years as some of these people start moving out of mom and dad's house and start getting into the apartment industry. Because if it does, we're right now 3.7 million young adults above the long-term average. So not 3.7 million, but 3.7 million above the long-term average of people living at home. So even if that just comes down some, that could add another million people into the maybe not all of them into the apartment market, but a high percentage of them into the apartment market, which again could very much provide kind of a tailwind for the demand for multifamily. So this talks, what we've got, the blue bars are new construction of multifamily, and the red is vacancy. So you may have noticed there's been a little bit of new construction over the past couple of years, right, with all the cranes in the sky. The numbers are, I think we had 250,000 new units delivered in 2014. We had about 220,000 in 15. We're going to be about 320,000 new units delivered in 16. What's interesting is as those new units are coming online, look what happens to vacancy. Vacancy has continued to drop. We're about 4.5% right now. And that's interesting. And one of the questions that people are always asking is, are developers going to overbuild? Right? And my joke is, of course they're going to overbuild. They're developers. Right? That's what they do. But the reality is that in this cycle, lenders are, I mean, if you talk to developers about what the lending market has done just in the last 6 months or 8 months, it has become much more difficult for developers and apartment complexes to get financing. Lenders are really pulling back on that by quite a bit. So I don't think from a national perspective, we really have a risk of getting too far out over our skis and having an enormous amount of rebuilding. I'm sorry, of overbuilding. If we go to the next slide. Now, if we look at the markets where the new construction is taking place, again, a lot of the usual suspects. New York, Houston had a huge pipeline, and then, like I said, they turned off the spigot. So that's 27,000 new units, 25,000 of them will be vacant. But it'll be that's an exaggeration. But Well, Houston will be interesting over the next couple of years. Now, the other side of it is Houston is a much more diverse market than maybe what people realize. You know, long term, they'll be fine. They'll work their way out. But they got a few years where it's going to be tough. Dallas, Fort Worth, Seattle. Again, I look at the percentages. So 2016 completions, we said 320,000 new units. That's about a 2.1% increase in our national stock. If you look at the cities, Houston 4.4%, Dallas 3.5%, Seattle 3.8%, Austin 5.8%, Denver 4.2%. LA is only 1.2%. LA is not a market that we see as getting overbuilt. You've got pretty good job growth. It's a huge market. It continues to be a destination city. So all in all, the multifamily market here looks very, very strong. But what's interesting is a couple of these markets are the ones that we're starting to keep a little bit closer eye on. Seattle, Austin, Denver, in that they've had very, very good job growth, and they got a lot of units coming online. And the question is that job growth going to continue? And is it going to continue to be able to justify the number of new units coming online? On the right-hand side, we see the markets with the least amount of new units that have come online. Again, you know, I think 5 of them are in the Midwest. A couple of them you get Sacramento, Oakland on the West Coast, and then Fort Lauderdale. We've got a research department really digging into it, trying to figure out who built 700 units in Cleveland. We have no idea. You can go to the next slide. So this is an interesting graph, and this is a very telling message. So the blue bars are single-family home completions, and again, this is going back to 1993. And the red or the orange section are number of multifamily units delivered to the marketplace. And then the solid line is household growth. Now, household growth is extremely important because household growth stayed at about 1 million to 1.1 million per year for about 7 years. And then it started going up in 2014. In 2015, it was 1.3 million, and 2014, it's expected to be 1.43 million. Okay, so it's increasing by quite a bit. But what's interesting on this is that, and keep in mind, household growth is different than job growth, right? Because, you know, Billy gets out of college and he's got an engineering degree and he can't find a job as an engineer, so he's living at mom and dad's house and he's using that engineering degree to be a barista, right? But then after a couple of years, he finally gets a job and he moves out into an apartment and a household is created. Right? Or, you know, 4 girls graduate from college and they move into a 2-bedroom apartment to save money, and after a couple of years, they're making a little bit more money, so they move out and they move into, you know, 2-bedroom apartments. A household is created. So that's why the household growth is very important. But I'm going to get a little bit granular and stay with me on this. But if we look at the numbers on this, I got to look at my notes, make sure I get this right. Trust me, it's worth the wait. So if you look at the numbers on this, 2014, you had 620,000 new single-family homes delivered. You had 250,000 multifamily units delivered, and you had household growth of 1.1 million. So you were 250,000 new dwelling units short of increased demand, right? Which is why vacancy continued to drop. 2015, you had 650,000 new single-family units, 220,000 multifamily, 1.3 million on household growth, another 350, almost 400,000 new dwelling units short of increased demand. In 2016, 780,000 new single-family homes, 320,000 new multifamily units, and 1.4 million new households. So what's happening is we have this construction that's taking place, but it's not keeping up with that increased demand. All right? And that's why we continue to see vacancy numbers coming down, right? And that's why we continue to have very, very strong occupancy levels. That's why we continue to have very strong rent growth. So it's interesting when I talk to people, they say, are we getting overbuilt? Is there a concern? There's certainly some pockets. There's certainly some submarkets that we got a little bit of concern about. But from a 30,000 foot view, the answer is no. From a 30,000 foot view, we are literally not keeping up with increased demand. So we can go to the next slide. One of the reasons for that is the single-family home construction. So this is and you gotta keep in mind what has happened in the single-family home construction market, right? So we come out of the recession, and immediately government goes in and they say, we're going to put enough regulation in place to make sure this never happens again. And they certainly did, because the amount of the laws, the regulations we put on the banks have made it impossible for the lenders to lend to the developers who in the past were out there building those starter home communities, right? The 3,200 pages of the Dodd-Frank bill make it extremely difficult for the new single-family home owner or that new young family to even afford or get through the process of buying a new single-family home. So what this graph shows, the solid line is the amount that housing contributed to GDP over a period of time. The blue shaded areas are recessionary times. So the long-term average is 4.7%. Okay, long-term average is that 4.7% of GDP comes from the housing market. But look what has happened in the past after previous recessions. In the recession that ended in what is that, 83? Oh, I can't see the bottom of my slides where I have my little cheat sheets. But that jumps up to 5.8%. And in the next recession that ended in 92, it jumps up to about 5.2, 5.3%. And in the recession that ended in 03, it jumps up to about 6.3%. And all that's happening within 2 or 3 years after the recession. We are 7 years after the Great Recession, and we're at about 3.5%. So what does this mean to you? From a multifamily standpoint, what that means is that a lot of people that are in apartments are not going to be able to afford to get out of apartments. They're going to be stuck there for a little while. And there are options. And at this point in the cycle, historically, this is when people have been moving out of apartments and buying homes. And it's just not the option there was in the past. So that's something that's definitely coming into play quite a bit on the multifamily side. Now this is an interesting slide because it has the information from before of completions, but we took the vacancy rate and we divided it. So you've got a vacancy rate on Class A, which is the orange line, and then Class B and C, which is the gray line. So in 2012, vacancy on A, B, and C were all at about 5.2%. What's interesting is in 2016, vacancy rates on A quality product is about 6.2%. Probably a little bit more if we were able to really get true numbers on economic loss and concessions and so forth. Vacancy rates on B and C is about 2.4%. Vacancy rates on that workforce housing has dropped substantially. And again, these are the people, as I was just saying, these are the people that historically have been out buying homes. And they really just don't have as much opportunity to move out of those apartments. In addition, a lot of the workforce housing people are spending a lot more money, a lot higher percentage of their monthly income on rent than maybe what they did in the past. So it'll be interesting to see how that plays out. Some of the discussion, I sit on I'm involved in National Multi-Housing Council, and we had our board meeting in Washington, D.C. a couple of weeks ago, and which by the way is a very interesting couple of days, because what happens is you're meeting a lot of senators in a very kind of small group and having discussions with them. And I explained it to somebody earlier today. I said, you meet a senator, start talking to them about your business and what you're doing, because really you need to make sure these people understand that some of the laws they're passing, they may be trying to accomplish one thing over here, and they're going to hurt our industry over here. And you meet some of these people and you think, wow, I feel pretty good about the fact that it's a very intelligent individual and they're representing our country and they've got a servant heart and they're really working hard. And then you'll meet another senator and you think, this guy can't even tie his shoes. How in the world did he get elected? And so that's one of the fun things happening inside the development. But one of the discussions that is starting to come up a little bit more is rent control. And actually, we were in the Long Beach office today and having a roundtable discussion with some of the people. Keep an eye out on that. You might start seeing a lot more discussion about rent control and expanding that. They're talking about putting it in place in Portland, in Seattle, and some other markets as well. So we go to the next. I don't mean to scare you. It's just, you know, you heard it here first. Wage growth and rent growth. It's interesting. This is a dynamic that comes into discussion a lot. And people are saying, well, wait a minute, you know, how can we keep raising rents and when our wage growth isn't happening quite as much? So to throw out the numbers, 2012, wage growth was 1.7%, rent growth was 2.7%. 2015, wage growth was about 2%, 2.3%, and rent growth is 5.5%. 2016, wage growth comes up just a little bit more. Rent growth now has dropped down to about 4.6%. What's happened is rent growth jumped up quite a bit, and then there's kind of an organic correction that's taking place. Rent growth over the next year, couple of years, is probably not going to be quite as nationally. It's not going to be quite as high as it was over the past couple of years. All right. In addition, wage growth has continued to increase, and we'll probably see that wage growth go up a little bit. But I did a calculation. It was interesting. I thought, okay, what happens if somebody is making $50,000 a year and they're renting an apartment for $950 a month, and their wages go up by 2%, and your rent goes up by 4%, right? What happens is that your monthly income increased by $83, and your monthly rent only increased by $38. So feel free to keep raising rents. But keep that in mind when people challenge you on raising rents. You know, you can't peg it to the wage growth number because you're talking about totally different numbers, right? Next slide. Transactions in the marketplace. Velocity is it looks like in 2016 it's probably going to drop a little bit for the first time in about 7 years, and this is not by much, just by just a little bit. But the point I want to make on this, and this is a very interesting dynamic, is that the amount of money in the marketplace right now is huge. I mean, the amount of equity looking for a home is enormous. So, I mean, if you own an apartment building and you're thinking of selling, and this is what Bogie was saying, the problem is not finding buyers. You guys are here to try to figure out, okay, once I find that buyer, then where do I go? I understand that. What the other part of it that's interesting is a lot of these funds are raising larger amounts of money. And I took a look at this, and I pulled it apart, and I looked at it from 2011 to 2015. And in that amount of time, and you can see that the colors break it down by price tranche. And in the $1 to $10 million range, in that time frame, the number of transactions increased threefold. In the $10 million to $20 million range, it increased by over 4.5%. And in the $20+ million range, it increased by over 8%, or 8 times. I'm saying 8%, 8x. And really, what is happening is people are coming in with much larger amounts of money and looking for a place to park that. And there's a lot of different reasons for that. There's very few investment alternatives right now. Multifamily real estate in general is doing much better than a lot of other investments. And as a result, there's a little bit of a froth in the marketplace that's pushing values up a little bit, maybe a little bit beyond. I mean, you guys know this, a little bit beyond maybe what the economics really makes sense at. But there is just such an enormous amount of money chasing that, and people are they're raising larger amounts of money and chasing bigger and bigger deals as well. We go to the next slide. One of the other things we looked at is we dug into this and looked at. We saw a couple of years ago, we saw a lot more money going out of the primary markets. And we saw money going into secondary and tertiary markets. And so we looked at this and we said, okay, of all of the transactions that are taking place, above $15 million in price, what percentage of these are going into secondary and tertiary markets? And they're chasing yield. And what's interesting is in 2012, it was about 38%. So 38% of the transactions in secondary and tertiary markets. In 2015, it was about 50%. So a much higher percentage of deals. This, once again, people are raising a lot of money and they're looking for a place to go with it, and they're starting to push farther and farther outside of the market area. couple last things. This is just from a is that to let me know what time it is? Sorry guys, getting carried away. Just a couple of things to look at from a investment standpoint. What this does is it's looking at cap rates over a long period of time, and it's looking at cap rates on a primary, secondary, tertiary market. But what's happened is over the past couple of years, cap rates on primary markets and preferred markets have really kind of stabilized. They haven't really gone down anymore. Secondary and tertiary markets, we continue to see cap rates come down a little bit. There's probably still a little bit of cap rate compression in those. If you're in a very good, if you're in a pretty solid market, which LA is going to kind of fall into that primary market. How much farther down are cap rates going to go? We're not seeing a whole lot of compression, but as you start getting out into some of those tertiary markets, we're still seeing a little bit of that compression take place. And then the last thing, just to point this out, one of the questions that one of the comments that I get a lot is, does it really make sense on buying apartments, or does it make sense on buying deals with interest rates as low as they are, or with cap rates as low as they are? And what you got to keep in mind is cap rates are going to be tied to where the interest rates are, right? We've still got a very good spread, and whether you're buying apartments or triple net or any other product type, the spread is still there. It's still strong enough that you're going to be able to generate very, very good returns. So just kind of in a summary of this, overall, a lot of people looking at new construction. New construction has picked up, but we're not even satisfying demand. I'm not worried about things getting overbuilt. As I look out over the next couple of years, I think the market is good. The market is very good. The market's going to stay very good, but the definition of good has changed. Okay, we're probably not going to have the froth that we had over the past few years. It's going to be steady, it's going to be stable, and things are going to probably continue to get a little bit better. But I don't see anything that is really going to kind of push things up from a skyrocketing standpoint. But again, the metrics of the market continue to be very solid. So thank you very much. I appreciate it.
When I first met John, he said that he's got 7 suits, they're all charcoal gray. And then when he met me, he said he was going to go outside the box a little bit. He's got a light charcoal gray now. All right, our next speaker, who's from San Diego, not quite the same distance as Chicago, but it took them about the same time to get here. Kevin Mansour. This speaker is going to be a little bit different. He's going to be a little bit more interactive. We encourage some questions, comments. Let me give you a little background on him. Kevin is the managing partner of the Mansour Group of Marcus and Millichap. He's one of the firm's top listing agents. Mansour Group has closed over $3 billion of net lease real estate in 48 states and is on track to reach $1 billion in closings this year. They average more than 3 closings per week, and of the 1,089 single-tenant net lease Marcus Millichap listings they are active. The Mansour Group controls 10% of the total inventory, and their experience and market share is an invaluable resource, and we're really happy to have Kevin here.
I don't like putting everyone to sleep with slides. Thank you. I'm a deal guy on the front lines, a little different. I like to talk and engage and answer questions and really a lot of the same questions I hear often when half of our business comes from apartment sellers, so you may not think we're as engaged with multifamily investors. The majority of our business comes from. The majority of our buyers come from multifamily sales, and actually the majority of that comes from California. We're based in San Diego, but the majority of our business is done nationally. What we bring to the table, most of our clients that list with us are developers. So we sell probably the highest quality net lease properties in the country. All the big name retailers that everyone's familiar with. Walgreens, CVS, Starbucks. Now we're getting really into medical, and I can go into that, certain segments that we're seeing a lot of growth in. But a lot of our stuff is new, brand new development, corporate leases. A lot of what we bring is out of state where there's a little bit higher return. But the biggest thing that we see from everyone asks us, what am I going to buy if I sell my building? There's a lot of uncertainty, a lot of questions that people have buying in different states. But with retail, it's probably the easiest investment to really understand because we're all consumers. We all go to restaurants, we all go to the pharmacy, we all, just depending on what segment we're talking about, there's auto parts, there's gas stations, there's convenience stores without gas stations. All of us are consumers, so if you really think about it, it's easy to understand because we're all really the same. We're all in the same boat. Another thing with Net Lease is the financing is readily available regardless of where the property is and where you are based geographically. Because most lenders look at the credit of the tenant. There's a lot of what we sell is more corporate back. There's a lot of franchisee stuff out there. 95% of what we do is corporate leases with the main Fortune 500 companies. So a lot of that uncertainty is taken out of the picture. So with Net Lease, you can look at 10, 20 years down the line. If it's a 10-year lease, a 15-year lease, an average Net Lease property is going to be 10, 15 years. Some product out there like Walgreens, CVS, Rite Aid, you're able to get 20-year leases. So if you think about it carefully, think of what investment you can go into and know what you're going to get for the next 10, 20 years. So we're able to position a lot of our sellers, a lot of our buyers, and really think about what they're going to do long term. Everybody has a different strategy. If you're looking to retire, not do all the headache you get with a multifamily, a lot of the risk. There's headache with leasing, headache with risk and what's going to happen with apartments and housing. I'm reading different reports that tell me all the baby boomers are going to get out of their houses, and then the next wave of millennials is going to go into renting homes because apartments are getting way out of hand and overpriced. So there's different things they look at. With Net Lease, a lot of that uncertainty is taken out of the picture. If you go into certain segments, the biggest growth we're seeing right now is in medical. As more people get access to healthcare, everyone's getting into medical. We're seeing a lot of urgent care, emergency room facilities because it's not easy to build a hospital. We're seeing a lot of ground up new development, dialysis centers for kidney health. Then you have the urgent care facilities and then emergency rooms, which are basically mini hospitals that can treat even if they had to heart surgeries. Some of the segments that a lot of people are also moving into, so there's Net Lease medical, Net Lease retail, and then Net Lease industrial and office. So people bring up concerns with how there's an impact of online sales on Amazon. There's enough out there like medical, restaurants, anything that cannot be put online. That's where we've been noticing the biggest growth in demand for. So industrial buildings are not as pretty as retail, but that's another segment that a lot of people love because you cannot really replace that, and you're going to need that regardless of what happens with online. These warehouse facilities, like FedEx, will have a Net Lease investment where you can get into FedEx. FedEx is not going anywhere anytime soon, especially with what's happening with online shipping, and that's only going to increase. One thing I do want to touch upon with the way our firm works and the platform, which a lot of people don't really understand, is what you get with our firm and how we share information. So apartment guys working with Net Lease guys, we get involved on the front end. not after you've sold the property where you're scrambling, put into a corner and calling Greg to save the day. That's not what our goal is to get involved on the front end. So even before you bring a property out to market, we will be in full sync with whoever's handling the assignment and time everything perfectly so you're not put into a corner. We don't even want you to make it to your 45th day of your ID period. Our goal is to line you up, everything in advance, show you stuff that's out there well in advance, make you comfortable, educate you on what we're seeing, give you the reality of what we're seeing nationally so you can make an educated decision. And then we will, once we're ready to make offers, we will pinpoint exact product that we're going after, line up everything. So the advantage with us is I already know what I'm working on next year, even end of next year, early 2018, because of the new development. I can see the supply. So I have the ability, so if you tell me you're going to sell an apartment, you're not ready to sell now, you're ready to sell in 6 months, I can line up at least sample opportunities or even real opportunities that we're going to have next year that we can line you up with. These are very high quality retail developments that we can line you up with, so you're never put into a corner. The biggest thing for us is not putting you in a corner, making rush decisions. A lot of these brokers out there, competitors of ours will say, oh, we can send you net lease properties, we can have access to this. You have to realize that you don't want an apartment advisor giving you advice on net lease. There's a lot of things out there, and a lot of people who are not intimately familiar with retail will claim to know, and at the end of the day do not know. This is all I do all day long. I'm going to close about 200 deals this year alone. We're a heavy volume team. I eat and breathe net lease real estate, and we also sell shopping centers and strip centers. This is all I do. I strongly urge you, when you have a team and you're looking to move into net lease, you need an expert that's going to give you the reality, tell you the pluses and minuses of every deal, versus just show you what you see on LoopNet. Anybody can go on LoopNet, you don't need a broker to show you that. But you need an expert that's going to explain to you what the challenges may be, what the risks are, and really to advise you as an expert versus someone who is giving you secondary knowledge and claiming to be an expert. I just threw out a lot of things, but I want to, if we can engage everyone with concerns, I like to start with concerns, always start with the negative, and then we can talk about other things. If anybody has any additional questions.
You guys doing hotels?
I actually come from hospitality. We're actually selling a net lease hotel right now in San Antonio with an 85-year triple net lease. That's probably the most passive net lease investment available today in the market. It's a interesting one. It's a 4-star luxury hotel in the Riverwalk in San Antonio. If anybody's ever heard of the world famous Riverwalk, it's a luxury hotel. The improvements are probably worth $40 million. We're selling the triple net lease to the hotel, and then 2 retail pieces that are part of it. And that's about $15 million for that, but you have over $50 million of improvements secured in that investment. So that's as passive as you're really going to get. That's a generational deal you can pass on to your grandchildren. But net lease hotels, that's something that's growing. There's maybe 2 or 3 deals in the market. You're going to probably see a little more of that, but not as much.
What's the cap rate on that?
We're asking on a 2 retail hotel, a 5.25 cap, and you have annual rent growth, and there's increases, it's fixed increases. So that's actually considered very favorable in our segment of the business, but you have to understand what you're getting. It's not a traditional retail investment, but knowing the hotel business, I think it's as secure as you're going to get. If they leave, the hotel fails, you get a luxury hotel that's really your collateral.
Could you give some range, as far as cap rates, could you give some samples or some ranges
Sure.
by segment or area, segment and area?
So the most sought after net lease investment is going to be fast food, quick service restaurants, McDonald's, Burger King, Taco Bell, In-N-Out Burger. We've tried to put a deal together recently on. Those are going to be the cream of the crop, the most aggressive. So depending on the region, I'll give you a range. So like California, McDonald's. I just sold one in Fresno actually at a 3.5 cap. It was a 20-year triple net lease. They had been there for 30 years prior. They signed a 20-year extension. That's going to be at probably at the lowest end of the range in terms of return. You can get down to maybe 3.25, 3.5. I'm bringing out a Starbucks and Taco Bell in San Diego, actually, infill locations. That's going to be best of the best, best in class net lease investment for like core real estate. You're going to be in the mid 3s to high 3s. Nationally, like a McDonald's right now, is considered best in class for QSR. You're 4 to 4.25 cap on average. You get into casual dining, that'll push up to like high 4 to 5. Some other not, like more regional concepts, you're like the 5 to 5.5 cap range. So like the Chili's, Applebee's of the world, Panera Bread, any casual dining, anything with not a drive-through. Your Starbucks right now are trading in like the 5 cap range for a brand new 10-year lease. We're doing some longer-term Starbucks right now that are sub 5 cap, but those are rare ground leases. You probably see a lot of net lease investments with ground lease. The term ground lease there, that's your most conservative investment because the tenant's paying and building and paying for the improvements. So the caps on the ground lease investments are the lowest in the market. There's only one downside to net lease ground leases is you don't get the depreciation. That's the main downside. But in terms of being passive and conservative, that's going to be it because if the tenant leaves, you get the improvements. So there's significant value there. So typically like ground leases, the rent's a lot lower, but secured by, and most of these buildings are very costly to replace. That's why people pay a premium for ground lease net leases.
Yeah, I own apartment buildings, and I'm not really very familiar with the whole triple net lease product. Can you compare and contrast the difference between the two investments?
From a return standpoint or from
Everything.
I can go on for hours. But speaking from personal experience, so some of the downsides to multifamily investments from just a management perspective is really the headache, the constant phone calls from tenants, the uncertainty of where rents are going to go, where they can go, new supply coming into the market. But a lot of it is really the headache that comes with it. And then you really have to look at, so if it's a 30-year-old apartment building, a lot of people forget that plumbing has a lifespan and the roofs have a lifespan. You can only do repairs and patchwork for so long. So people forget that you have to replace plumbing, replace HVAC, replace the roof. That kind of stuff is really what you don't see in the net lease world. Depending on what structure of lease you're looking at, if it's a double net lease versus a triple net lease, and then there's absolute net lease where there's completely no responsibility from the landlord's part. With retail, you take a lot of that question, and you know what you're going to get long term. If it's a brand new building, say even if you have roof responsibilities, you have a 20-year warranty, you know what you're going to get. There's fixed rent increases, you know where the rent growth is, you know what you can count on. It's coupon clipper, you sit at home, you literally get a check in the mail or it's wired to your account. And the check will say McDonald's, it'll say Walgreens on it. These are global, international tenants that to me, I couldn't ask for anything else. If you're looking for peace of mind, my family got out of the multifamily business and retail's our favorite. Really, I can't think of a better investment where you're going to sit at home or travel, on an island where you just get a check in the mail from a Fortune 100 company. There's nothing else like that. You can go invest in bonds. You don't get the appreciation benefits. There's no intrinsic value. There's a lot of uncertainty. To me, the stock and bond market, you're gambling. So a lot of people tell me, oh, I can invest in a Walgreens bond or a McDonald's bond. Yeah, but you don't get something that you can go and touch and you can sell. Something with Net Leases, if you ever want to get back into into multifamily or other retail, you can exit out of Net Lease very quickly. Assuming you have a long-term lease, or even if you have a shorter-term lease, we can advise you on maximizing value versus just selling off a short-term lease. We would actually sit down with you and talk about how we can get a tenant to extend early so we can maximize value on the sale. So on average, if you come to us and say, I want to sell this net lease property, I'm done, we can sell off the rent increases that are coming up, capitalize out on rent growth, and get out of it in 60 to 90 days. I mean, that's a conservative number. So if you ever want to get back into multifamily, you can do that very quickly. Most people don't do that though. Most people will refi, take their equity out, buy more triple net, or go back and diversify into other segments.
So what is the equity in a triple net? I mean, are you expecting appreciation in the value?
Yes, so depending on where you want, if you want to chase yield, there's that segment of the world in that lease. My recommendation, along to the most conservative investors, is pay for quality real estate. That's really where you're going to see your appreciation. Quality real estate, if you have rent growth, great challenge with like Walgreens is probably the most sought after 20-year lease in the market. The problem with drugstores is you flatten rent structure for 20, 30 years and sometimes even longer than that. So you don't get protection against inflation. So that's something that you're getting the best corner in the town. So you can always have an exit if they do leave for whatever reason, but you don't get rent growth. But my recommendation to the most conservative investors, pay the premium, pay for good real estate. At the end of the day, it's very hard to lose. If you have a great quality corner, there's always options, always options.
Can you describe briefly the financing? Let's see. The lessee or the company that's going to be leasing determines the confidence that whether the lender is going to loan or not?
That's where most of the confidence comes from. Obviously, they want a strong borrower, but predominantly what they're looking at is the credit of the tenant. And a lot of these lenders will actually get their rent, their loan payments directly. It'll be wired directly to the lender, and then your portion of your cash flow will be sent to you. The lender will get their check directly to the tenant.
So the minimum principal or the minimum.
On average, your minimum down on net lease properties is between 30 and 35%. You want to be very conservative, you can put 40 to 50% down. On average, it's 30. That's the magic number.
And the costs. You're doing this for a fund, or is it typically the cost of closing a deal is a percent of the?
Yeah, so our commission comes from the sellers. There's probably been one deal over the last 10 years where I've had to go to the clients. It's extremely rare. We are paid from the sellers. Sellers pay us their commission. It's very clear. Yeah.
Is there any pros to land lease triple net property?
Higher return. That's really all you're going to get. You're talking about leasehold, where you're just buying the improvements.
Yeah.
You're chasing return there. I've sold quite a bit of few of those. It's a higher yield on average, 200 basis points higher. But the challenge there is once the lease term drops below 30 years, if you ever want to sell, it's not real property, so we're not qualified for 1031. So that's a big problem there with those deals. But you can chase yield. It's great. I don't recommend it. But if you're chasing yield, that's really all you're going to get. You can get credit and yield, but without the land, you're always limited. I always like to look at the exit. What's the worst case scenario? If I want to sell, those are going to be more challenging assets to sell. The buyer pool is very limited.
Is there a benefit because of the depreciation since there's no land?
You're going to get the depreciation either way. You're not going to depreciate on the land. So on a traditional net lease investment, you're going to get the depreciation regardless if it's a non-ground lease, what I was telling you earlier, where we're just selling the land. You'll get the depreciation if it's building the land, which most net lease properties are.
Aren't you depreciating all of the whole price, the money that you pay for it, instead of not some of it, which is the land?
You're depreciating on the building, and that's really what you're going to get. You're not going to get depreciation on your land. Yeah.
So how easy is it to sell a classic retail triple net lease, whether it's Walgreens, or fast food, gas station, or whatever? I mean, how really easy is it?
On average, if it deals priced correctly, and depending on how aggressive you go to market, if it's priced at market, you should have offers within 30 days. If you don't have offers within 30 days, you're priced aggressively, or there's a challenge with the property. This is assuming there's no environmental issues or anything. If it's a conventional deal, you should have offers within 30 days. If you don't have offers within 30 days, the pricing is off.
When you say price proper, say sell price that's less than what you paid for it, or?
Not necessarily. It all depends on where the market is, at any given time. So if you bought something 10 years ago and you were to go to market today, there's 10 years remaining, you would have most likely already had 2 rent increases that you're going to capitalize on. And where caps are today, we're at historical lows because of where interest rates are. You can borrow right now for net lease retail for 10-year money like in the high 3s to low 4s depending on the concept. So for retail, it's very favorable.
So the sale price is predominantly only based on what the stream of income is that what you're saying, as opposed to the potential appreciation of the property itself?
Well, it depends. So if it's a deal that is below market rent, you're going to sell at a certain value. It all depends on, there's so many factors. If the rent's below market, somebody will pay you top dollar for that property because they're going to capitalize. In some cases they'll want the tenant to leave so they can put another tenant in at a higher rent.
Do you prefer a single tenant triple net deal or like a 2 or 3 tenant?
So that's a good question. A lot of people bring that up to us. So on the net, if it's single tenant, there's no headache. It's one check, one tenant. A lot of people say, oh, I'd rather have a 2 or 3 tenant strip center. It's that you're diversifying your risk. I don't look at it like that. I like strip centers. I think you're able to get a higher return, but you have to manage a strip center. You have to build tenants for common area maintenance, for expenses, for management. A lot of times they'll reimburse you for management, which is good, but you have to get involved. If one of the tenants leaves, you got to, rollover costs, leasing commissions, TI. There's a lot more involved versus just a single tenant. That's easier to understand and get your hands around and no headache. I'm not opposed to it, but there's more management involved. A lot of people like them too because it's minimal management and they can build the tenants. So Starbucks will pay you, Chipotle will pay you an admin fee or management fee on top of whatever the maintenance costs are for your time for that. So you're not losing, you're not coming out of pocket, but there is a little more management where you're not going to get reimbursed the management fee for the multifamily building. They will reimburse it. That's built into the leases.
When we're doing business in California as opposed to other states, we talk about recourse and non-recourse states. Does that apply in any way to the triple net? Recourse states, non-recourse states?
Not necessarily. If it's a credit tenant, it's going to be non-recourse. You're talking about just financing. So, most credit financing is non-recourse. Some programs that are very aggressive that we're able to source as partial recourse. It's not the end of the world, but predominantly it's non-recourse financing on credit or credit tenants.
I have actually kind of 3 questions here. Are most of the properties that you guys
Good question. So on average, the average net lease property will have 10 years of term. We sell some properties under 10 years. A lot of that product comes from more institutional sellers that are looking to just bulk exit net lease properties on certain portfolios they have excess properties of. But majority of what we have is going to be over 10 years. Majority are triple net, and a small component of that is going to be absolute net. So there's absolute net, zero landlord responsibility, zero management, check in the mail, that's it. Those are going to be the ground leases that I was talking about. Most Walgreens are absolute net. They're not ground lease, so you have building and land. Most CVSs are triple net, absolute net. Then there's the like Starbucks of the world that are triple net, but you get a roof warranty for 10 or 20 years. So one thing I can bring up there, a lot of people pay in the marketplace, there's a 50 basis point on average gap from an absolute net lease and a double net lease with the roof responsibility. If you do the calculation, that 50 basis points will, in most cases, is going to more than cover the cost of a new roof, even at the most conservative level, 20 years from now. I don't feel that the market gives fair value to double net leases. I think, what's the worst case scenario? 20 years from now, you're making 3 or 4 phone calls to a roofer, setting up for the property, and you deal with that. I'd rather take 50 basis point, a higher return on the front end, put a reserve aside, and you can be very conservative, set a reserve aside for the roof annually into an account, so 20 years from now, you have it all covered. Some very, very conservative lenders will require a reserve for the roof, but in most cases they're not. They'll underwrite that expense, or they'll underwrite a management fee if it's a more management intensive property, but majority of them do not underwrite that. They will on multi-tenant, reserve, management, vacancy allowance, that's for sure, but on single tenant,
What
that's
about
not.
the out clause?
Oh, the out clause,
Yeah.
some, yes, have early termination. Starbucks recently has been throwing in early termination in some of their leases, but these are with landlords who are not as experienced and they're getting taken advantage of. So this is why it's very important to have the right team handling this, so that we can really point out the issues with some early termination, but the majority are not going to have early outs. A very high majority.
What part of the country do you like right now? Do you like the Southwest, Texas, Southeast?
So so everyone loves tax-free states. A large portion of our business is done in Texas. A very large portion in Texas, because as you saw with some of the growth numbers on these slides, Dallas, Fort Worth, Austin, Houston is still strong, and then South Texas, some of the border towns, get a lot of international retail trade, so that cross-border traffic, some of the top retail markets in Texas are in South Texas. It's similar to what we see in San Diego with the benefits there, but Texas is probably number one because of the quality, it's new construction, and the high growth that we're seeing there. It's a very pro-business state, so everyone loves it. Florida's another big one. And then Southeast, there's some really strong markets that a lot of people like. And then we do some in Arizona, Nevada. A lot of people like to stick with the West Coast because of familiarity. Washington State's very, very sought after. There's very limited supply that comes to Washington State. It's also tax-free states. A lot of people like that. But I would say the Midwest is probably the biggest that we see.
Is it customary in triple net or absolute net, say with McDonald's, Walgreens, to have an option to buy after a 20-year lease?
No,
It's not.
that's very rare. They will have a right of first refusal.
That's what I mean.
Okay, so that's, if you ever go to sell, they'll have the right.
Buy first.
Yes, I've sold over 200 drugstores over the last 3-4 years. I haven't seen Walgreens execute on any of their roofers. They're actually getting out of real estate and just focusing on what they do best, and that's pharmacy. So we're advising them on actually exiting their real estate. We're in discussions with them on doing that
right now. So that's something I wouldn't worry too much about. It is a procedure, formality that we have to go through in the process, where you send them the notice that you're looking to sell, and they usually have, on average, it's 21, 30 days to respond. I've only seen a couple of retailers recently exercise. Chase Bank on a couple of deals. These are like high-profile locations that they really wanted. Jack in the Box actually just exercised one deal we had in Arizona, but it's something they really wanted. It's very rare. It's a formality you have to go through. That's something that you want to bring up on the front end, especially with an exchange. You don't want to be put in a position where you tie up a property, tenant exercise. So what we'll do is we'll negotiate with the seller any out-of-pocket expenses that come out of your, that ordering third-party reports with the lender, legal fees. We'll ask the seller, in most cases, we're able to negotiate this, or we'll say, if in the rare event the tenant exercises, the seller will reimburse you. Usually it's like $10,000 to $20,000. So that way you can feel comfortable going into the property and not losing money.
Give us your best scenario. We own a 15-unit apartment building in the beach community. We're thinking of transitioning into retail. Give us your best scenario of what we should do.
I always tell people, I'm advising my father, I would buy, again, pay premium for quality, high quality real estate. You're going to sacrifice on return. When I say high quality real estate, I'm talking top 10 metros, infill, in many cases hard corner location.
Would you put all the money into one property, or would you diversify?
I love debt, but I'm conservative, so my version of conservative is 50%. A lot of these lower cap deals, it's hard to even discover the debt. Depends on what your cash flow requirements are. If you say, Kevin, I'm relying on this income, we're not going to be able to push the leverage on some of these really passive quality deals. We'll put a small loan in place, or we'll close the cash and maybe pull out some equity after post-closing. But to be very conservative, 50% is ultra conservative in the retail segment. I like to diversify, always. Unless you find a home run deal that it's a real estate, then close it cash, and then again, satisfy the exchange, and then we'll take money out post-closing, and then put you into something else. That's really the only event I would want, and we would advise on that. But you're always better diversifying. You're gonna be, and we can go into different segments. We can do food, we can do medical, we can do drugstore. Again, foods is really the most sought after right now, because technology has no effect on it. Internet technology. But we would sit down. So everybody has a different story. Everybody has a different plan. A lot of people tell me, listen, I don't want my kids touching this money. People come to us and are terrified of the millennials that John was talking about. Because they're clueless. They don't know the difference between a dollar bill and a $100 bill. So they tell me, I want the most conservative lease investment out there, 20, 25 years. I don't want them to touch this, and we will advise on that. And we'll say, listen, here's what we're going to do. Here's a deal. Nobody's going to touch this. It goes into the trust, and it's locked. If you tell me, I want to hold something for 10 years and maybe sell, we'll advise differently. There's a different story for everyone. There's not a general formula. We will customize our recommendation to you depending on what you want us, how you want to position your retirement, your long-term, your family.
How much does it pay for the next cruise? How much does it pay for your next cruise? That's awesome.
Yes.
As far as financing, you're looking at recourse loans, non-recourse loans, interest rates, down.
Yeah, so on average, it's 30-35% down. Most of where we're seeing on the credit financing, it's high 3s to low 4s for 10-year money fixed. Something to also point out, so say for example you have a 15-year lease with a kick out after year 10, somebody brought up kick out. A lot of these lenders, you can negotiate 15-year loan, but it'll be fixed for 10 years. If the tenant exercises or doesn't or fails to terminate, they just continue their lease, that additional 5 years of loan term that you negotiated on the front end will kick in. So that's something that we would recommend doing, especially in today's market. You need to secure as long-term debt as possible. That's our recommendation. Yeah.
Okay. With technology and the Amazon effect, are there certain assets you would avoid?
Yes. So like, you have like the Best Buys of the world, anything with dry goods is concerning for me. Anything that you can imagine that can be sold online is a concern. But a lot of people forget about some of the emotional effects of shopping. So like you have to, when I talk about dry goods, like Ross, TJ Maxx, a lot of those retailers are still very strong. But generally speaking, anything electronics is going to be probably obsolete. Auto parts, maybe, but auto parts do very well in like lower income areas where you need the parts the same day, so I don't see that changing anytime soon. I'm trying to think here, go through all the categories. But the biggest issue has probably been electronics.
Groceries?
Grocery is one. It's a good question, but groceries are very convenience-based thing. It's tied to the neighborhood. A lot of people love grocery stores. They haven't really hit it off online because there's a quality question mark. Always think about quality. You don't know what you're going to get online. With electronics, you know what you're going to get. It's a Sony TV in a box. With grocery, you don't know what you're going to get. There's a question mark there. So groceries still very sought after. So we sell Trader Joe's, Whole Foods. They're still very sought after. Those are very community-based retailers. They're a destination. People really enjoy going there. It's a whole experience of dining, and I'm not as concerned with grocery. So a lot of the institutional guys out there, a lot of the large investors, grocery is top of their list right now. Anything necessity-based. Drugs are one question mark. We're probably 2 or 3 laws away from having everything go online. But there's so much money on the pharmaceutical side that will block that. I don't see that happening anytime soon, maybe 15, 20 years with Walgreens and stuff, but a lot of these pharmacies have clinics inside, so they're getting income from other sources and not relying heavily on one segment. But if you look at some of the statistics with baby boomers and retirement, we're just getting started on requirement for medical needs and especially pharmaceutical.
What about medical marijuana?
I mean, it's gonna. I have a feeling they're gonna legalize it, and you're just gonna see it at every store. So I don't see the impact there. But dialysis centers have been huge for us. There's a lack of supply for dialysis for kidney health. I love medical, especially if you look at where the retirement's headed. Everyone's going to need medical attention, and that's only going to increase. We can go on for hours. Yeah.
Stay for the weekend, ask questions. Before I introduce the next speaker, I just want to tell a quick story. Recently this year, I had a client who sold about $16.5 million worth of apartment buildings here in Southern California, and we brought Kevin and his team in on the deal early on, and they had very specific criteria. They needed to buy in 4 different states, which were the tax-free states. Washington, Nevada, Texas, and Florida. Each property had to have a minimum of a 10-year lease. Each property had to be annual increases, and each property had to be newer construction and investment grade. And we were able to complete the exchange in about 45 days. We were able to find 7-Eleven in Florida, Chase Bank in Texas, 2 Starbucks in Texas, and a McDonald's in Washington. And they were just a great help in putting all that together. And And the buyer came with 50% down on each one of the deals. They financed the rest, and they're about in their mid to late 80s, and it was a kind of an estate planning project for them, for their children, and the 1031 was extremely successful. All right, next speaker, Robert. Robert Hodge works for Millichap Capital Corp. Robert is Senior Director, more than 12 years of experience in commercial real estate finance, more than $1 billion closed transactions. He secures commercial real estate debt, equity financing for an array of property types, and has guided clients through a variety of financing challenges and market conditions. Robert is extremely well connected with national, regional, and local funding sources, including agency lenders like Fannie Mae, Freddie Mac, HUD, FHA, commercial banks, CMBS lenders and life insurance companies, private and public funds, and bridge lenders. And I can personally say that I've closed a lot of transactions with Robert, and one of the best things that I can say about him is that he's not a super fast talker, and sometimes when you're talking to the lending world and they're throwing around rates and margins and swaps and all these kind of crazy terms, Robert takes his time with people and really gets to know you and understand your goals and can walk you through the transaction. So, welcome, Robert.
So, I want to start with, most of you guys own apartment buildings, and this is going to be completely different going into triple net deals. I deal with a lot of finance for apartments. I also deal with triple net and a lot of the owners that move from apartments to triple net. So I want to give you an idea of differences that come from an apartment loan to triple net. If you guys have any questions in the middle or at the end, let me know. But I would say triple nets vary a lot, and the Mansour group does a great job, and they sell a lot of newer, nicer properties that are corporate guaranteed. I'm not always dealing with the people that own those or they're buying them, so I see a variety of stuff from short-term tenants, not necessarily good quality tenants, people that bought through other companies that struggle and they're trying to get out of a bad loan that they're in. We're not usually dealing with that on the front end, but I deal with all kinds of stuff. A couple things. There's a lot of different types of lenders out there. When you're dealing with multifamily, you have lots of options. They're very plentiful right now, and they have been for years. The rates are very good. Talking about triple net, you have your banks, and you have business banking, as well as regular banks that will provide loans on them. You have credit unions. You have lenders that just specifically do triple net deals. That's all that they're working on. You have CMBS lenders that are doing high leverage, and that loan is being sold off on the secondary market. You also get life insurance companies that come into the mix that can provide very good financing for long-term fixed, usually more conservative properties, conservative leverage, but high-quality properties. Typically, when you're going to get an apartment loan, you can get very low costs on the front end. Get an appraisal that's relatively cheap. You're getting high leverage, and you get a fixed rate, 5 to 10 years, and it's going to roll to variable for the remaining term of a 30-year. And that's probably what you guys are used to. Values go up. You have a lender calling you saying, hey, we can refinance, or someone's telling you you pull out this equity and reinvest. It's very common. I do it often. You guys have probably dealt with it and helped grow your portfolio that way. The triple net side is different. You do get lenders that will do 30-year amortization. A lot more common, you'll see 25-year amortization. So that's something to think about when you're factoring in what your cash flow is going to look like. Something that changes is you're not often getting something that's going to be a fully amortized loan. Oftentimes, a lot of lenders are going to have a balloon payment, and you're not normally seeing those on apartments. Maybe a 10-year fixed. Some of the business banking options out there will do things that mature in 5 years or 7 years, depending on what that lease term is. They don't want to go beyond that lease term. And if you bought a property that had a 15-year lease, and you got a 10-year loan, and now you need to refinance, there's 5 years remaining on that. If you're not selling, you need to refinance, and you're looking at a different group of lenders. You have your lenders that want the 10+ year assets, and then you have a group that will look at less than 10 years. Once you get to maybe 3-4 years, there's not as many options. And it comes down to how is that real estate, how is that property performing? Because we might be looking at a different tenant. The lender's looking at it like you. Is this going to be a good location for a new tenant to come in? What's the market rent? I see that sort of scenario when I'm dealing with people that are coming to refinance when that initial loan has matured. Generally speaking, costs will be a little bit higher than what you normally see for an apartment. Appraisals are not generally as cheap. You have a lot of lenders that require environmental. They want to do a phase 1 and make sure that there's no environmental issues. If you're dealing with a brand new property, there might be one that was recently done. Also, an ALTA survey might be required by your lender, depending on where you're going, to see exactly what that asset is. Again, there might be one that was done by the previous owner that can be used. But those things you're not thinking about when you're getting an apartment, at least not all the time. Loan terms, you can get 5-year, 7-year, 10-year fixed. That's pretty common. Going out beyond that, it can happen, and especially with the longer term leases, you get a property that has a 20-year lease, 25-year lease, not as often. There are some lenders that will do a 20-year fully amortized loan, or match if you have a property that has 18.5 years remaining. They do an 18.5 year fix that has the same amortization. What you don't see as often is the cash out on the refinances as the property's appreciating, because the appreciation isn't like your apartment. You're not going to be pulling cash out of this every 2, 3, 4 years. A lot of times people are either trading another property or just refinancing the debt. Maybe they're pulling out some money, but it's not a continue to pull out that equity like you do a multifamily. The rates will vary, and it's going to depend on if you're dealing with the different tenants, the different loan sizes. As you get to smaller, they're generally a little bit higher. You get to the higher quality properties that are more expensive, rates are going to be better. Again, your investment grade, similar to what Kevin said, high 3s for 10-year fixed to low 4s. And if you're dealing with short term, you might be in the low 3s, depending on the property type and what you're looking for, up until the high 4s, depending on the property type and the tenant and how well that tenant is doing. Talking about tenants, you have most of the tenants that we deal with are corporate guaranteed leases. And my question that goes out on all of them, do we know who the tenant is that's actually signing? Because it's not always clear, especially when you're dealing with some other companies and looking at their listings. Who's actually signing, and do we know how they're doing? Sometimes it's a public company, sometimes it's private. If it's public, it makes it a lot easier. You have a company that's rated BBB- or higher, investment grade, that's ideal for the lending world. Something that's non-investment grade, you have a McDonald's on one hand and a Burger King on the other. McDonald's trades at a lower cap rate, it's more desirable. Burger King not doing as well. It's the same with financing. One is a lot easier than the other to finance. Let's see. Talking about non-investment grade, you'll see a lot of lenders that don't want to be as aggressive in leverage, maybe also the rate, maybe also the amortization. They're going to start looking a lot more at who's the borrower, who's actually performing at that store location, how are the store sales. We don't have a big tenant that's going to guarantee this. What are store sales looking like in that location? Are they trending upward? Are they been flat? Are they going down? Those sort of things help us with getting good financing still when you have a non-investment grade tenant. You also have scenarios where you have a larger company like Walgreens that is acquiring a Rite Aid. That may be to your benefit. You also have to take into consideration if that's happening, is there a Walgreens right down the street from your Rite Aid, and will they close down this Rite Aid to keep that Walgreens? If they're not, you might be in a better situation where your tenant just got upgraded. You have different things. I have people that look at office supplies. They have mergers that happen. Might be to your benefit, it might not. So just different things to think about, and having the right advisors that are helping you buy the property is helpful. Tying in the lenders, I would say that's early on, do that. Make sure that you're making a decision that's going to tie in the financing. A lot of times we have clients that are selling a property and they're not sure exactly what they want to get into. We talk about a lot of different scenarios. It's common for us to get people that want to put more money down. It just helps them feel more comfortable. They're putting 35, 45% down on a transaction, maybe even 50, because it makes them feel comfortable, because it's something new for them. It's not a bad thing. I don't advise against it at all. It just really depends on the scenario that you're looking for. It's different for each client. Talking about property types, from the lender side, if you have investment grade, it's not as big of a deal. If you have non-investment grade, a multi-use property is more desirable than a special use property. A Walgreens can become a lot of different things. Auto parts store can turn into a different type of property. So lenders like that. If that tenant were to leave, what else can go in there? If you get something like a gas station, it's always going to be a gas station. If you have a restaurant and it's not investment grade, that restaurant, a lot of restaurants fail. Their lenders are nervous about what else will go in there, and if one restaurant's failing, will another restaurant struggle as well? So you'll get lenders that want to do shorter amortizations for non-investment grade, or private companies that are not doing as well, or can't prove that they're doing well. Multi-purpose, I would say, is something that people don't generally think about, but it's, again, not as big of a deal when you're buying a newer investment grade asset that is top tenants, I guess. Transaction differences that you'll see. A lot of times you can get an apartment loan pretty fast, and when you're figuring out your contract, know that things aren't going to move quite as fast. You're not going to have as many lenders out there. There's not 20, 30 lenders that want to do your apartment loan, or do your single tenant loan like there are apartments. Non-recourse is definitely possible. You get to the properties that are less desirable, it's harder to get. It's harder to get a non-recourse if you want to refinance a small property that's non-investment grade, not corporate guaranteed. The exit strategy is definitely something to look at. The lenders look at it. What's going to happen when our loan is done? How are you going to get out of this? What's that lease going to look like? What's that property value going to be based on that remaining term? Credit issues. I personally, here locally, someone can have very rough credit, not good income, tax returns don't look good, whatever the case is, I still can get it done. When we're looking at borrowers that are not doing as well or had their rough spots, you're not going to have a ton of lenders that are going to want to do that. So one of the things that we've done to get past that is lower leverage. Lenders can assess the risk. You're not going to get a 70% loan on a property when you have real low FICO scores, you've had loan modifications, that sort of thing, and we ran into that. We've gone through and had clients that we started down one path and we find out these credit issues, and we quickly move to a different asset that's going to still give them what they want, but we can get a lender that can be more aggressive. It's one of the properties that we have up here. Here's a couple deals that we've closed, not necessarily highlighting any particular thing, but more of a variety of things. This is multiple of these have been done with Bogie's group. So this is a Starbucks that we did, 62% LTV, 25-year amortization, 10-year fixed. Client exchanged out of an apartment, moved into this property. They liked Starbucks. It was obviously a great investment for them. A lot of these tenants, they're good, or the properties are newer. The location starts to come into play on the financing. If you're right in the heart of a major metro, it's great. You're in the top 10 metros in the country, it's great. Some people they're going after a little bit different yield. They go into smaller towns. Some of these that I have, they're really small towns. But this was in Oklahoma, very good property, and we did this just recently. Go to the next. This was a Walgreens. Same client purchased this property, smaller town. This was also a Mansour Group property and Bogie's investment as well. They had a lot of money coming out of Exchange. They put more money down into this because it was a smaller town. We got a shorter term fixed and went off a 7-year fixed, 7-year term, but still the leverage made them very comfortable that they're going to be in a good position. We had a very short prepayment penalty put on this, so they have flexibility to do what they want. They got Walgreens to renegotiate a longer lease. They can refinance without an issue. It's 2000 construction. Next slide. Rite Aid had a client that exchanged out of a property out in the valley and bought a larger Rite Aid. This one is a little bit older, just to show an idea of Rite Aid was not doing so well at this time, and this was one of the larger Rite Aids at the time. He got 70% leverage, 20-year term. This was up in Washington. It was a small town. There was no other pharmacies around it. Second triple net deal that client had exchanged into, he bought a Jiffy Lube in Baton Rouge, Louisiana that we financed for him. But this one was doing really good. Store sales were really good. We got high leverage with a shorter amortization because the cap rate was a little bit higher on this at that time. Since then, Rite Aid has done a lot better, and his investment has definitely increased for him. Dollar General, this is something that maybe a lot of you aren't as familiar with. The dollar stores, the Family Dollar, Dollar Tree, Dollar General. They're smaller generally. They're not as high price point. Dollar General specific, they like to go into small towns. We did a portfolio of 3, and this was a very small town. There's 3 locations. The combined population for all 3 were just under 2,000 for 3 towns. They were brand new stores within a year, original 15-year leases. We did 10-year fixed. 10-year rate was a little bit higher, 4.58, but we were able to get 30-year amortization, which helped the client's cash flow. He exchanged out of an apartment in Long Beach, and as soon as he went under contract on this, the guy went on 2 cruises during our escrow, and says all he's doing is vacationing. He doesn't want to think about dealing with his apartments anymore. And he was happy as can be. Next property, this was a sleep train. This was a client that had some credit issues, and we switched from a different investment into this property. This was in Cathedral City. Palm Springs was a brand new property that opened while we were in escrow. Multi-use property. They set it up in a snap when the doors opened. We did 2 years interest only, followed by 28-year amortization. It was a 10-year term. We had a 3-year prepayment penalty, and this client was at a point where his credit was going to clear up in a couple of years. So that interest only payment really helped him to have good cash flow until then, and he's likely to refinance when his credit's better into a 10-year fix. But we were able to do this corporate guaranteed lease. Non-investment grade, but the tenant's still doing decent, $2.5 billion in sales, 3,500 locations. They actually acquired a property shortly after acquired another company shortly after he acquired this property, which gave him roughly another 1,000 locations. Next property is DaVita Dialysis. This was in Grand Prairie, Texas. Client bought this property when it was relatively new. They went out there, they loved the fact that medical was in such high demand, and they were building another dialysis center across the street. And the client immediately called me and said, am I making a mistake? Should I be buying this? I told her it's not necessarily a bad thing, but do your homework. We're going to do our homework. And she spent maybe 4 more days there and went to all the surrounding area dialysis centers and talked to them. How is business? How are things going? And she found that everyone just has a waiting list. There's so much demand for it. They need more to open. and she was happy as can be. That's why they were opening another one across the street. Business was not an issue for them. The Vita did their homework before they go and sign a new lease. So this, we did a 65% leverage, 30-year amortization to give higher cash flow, 5-year fix, and this had no prepayment penalty. It was the first triple net that they had bought. Everything had been local in the South Bay for this owner. They actually pulled money out of a property that we refinanced in Lawndale to buy this property, and they were nervous and wanted to get no prepayment penalty so that if they didn't like it, they could sell. But I don't think that she's planning on selling this anytime soon. She's loved the fact that she has very little on it and business doing well. Next property was a client that we did a couple triple nets for, and it was actually a family where the client that we originally were talking to passed away in escrow, and it was very sad. But the borrower that we were dealing with, he wanted to stay in automotive because his brother had been in automotive all his life, and we got him into Jiffy Lube and a Valvoline. His Valvoline was in Riverside. They were putting a lot of money down because they wanted to be conservative. 30-year amortization, 5-year fix, 4 1/4. Had a 3-year prepayment penalty. There was 9 years remaining, but we had a 10-year term, so it went a little bit beyond that lease. This was not a corporate guarantee. This was a franchisee. This is the largest franchisee of Valvolines out there. Property was in very good condition across the street from a major shopping hub. So they liked the investment. It was newer, it looked good, but there's not a lot to it. If you talk to most lenders, they don't necessarily want to go into automotive, but it still worked out as a good deal for him. And with a low leverage, it made a lot of sense for the lender and the client. Next property, this was a property that was in Northern California. Client sold an apartment in West LA, and he bought a couple properties. This was one of them, and this was a challenging deal. We had a great tenant with the U.S. government. There's not a lot where they don't have some sort of out clause if they shut down an department or doing cutbacks where they can't get out of a lease. This one had no out clauses. They had been there since, I think, when the building was built in the 70s, and they had grown at different terms when they renewed the lease. So he bought this property, put down 45%. We did a 20-year amortization. The lender was concerned with who else can lease this place. The town was just under 800 people up in Northern California. But they had shut down 4 other U.S. Forest Service offices surrounding this one, and this was the big one. They spent roughly $1 million about 3 years prior to this to expand it, and it was clear that they were shutting down the rest and expanding here. This was their long-term goal to keep it. So those are just variety of stuff. We obviously can do the brand new corporate guaranteed triple net deals, but we also have the ability to do a lot of different things. We're going to work with you. We're going to work with Bogie. We're going to work with the Mansour group to help you find the right investment and the right debt to go with that. I wanted to open it up if anyone has questions, anything that I can help with. Yeah?
Can you recall the cash flow that any of these properties were producing?
I would say that almost every one of them, they were making more than their apartment. It's very rare that they do not make as much as their apartment. Sometimes people are just trying to keep cash flow the same, but get to something that really it's hands off. They don't have to do anything anymore. Sometimes we get people that cash flow is not as important, and they'll ask for the shorter amortizations to pay it off. They have a business that they're making good money on. Right now, let's pay this loan down. Let's do a 15-year amortization or 20. It gives me the flexibility to add more if I want. And the cash flow maybe isn't as good when they do the shorter amortizations. But generally speaking, they're moving up, and in some cases, they're moving up tremendously. That Rite Aid, the client was making a ton more money than the apartment that he sold out in the valley.
Should probably touch on the return on equity.
Yeah,
A lot of people
so
don't understand.
the return on equity when you're buying an apartment, I mean, all of you guys look at apartments here, and I see it as well. You're scratching your head. How am I going to make this work? Where is the upside? What do I have to do to make it to where there is some cash flow? As you go into these other assets and triple net, your return on equity is going to be much higher, and it's going to depend on what you're buying. Obviously, if you're buying a 3.5 cap McDonald's, you're not going to get as much, but you don't really have to worry about it. You could buy a Walgreens 5.5 cap that is going to give you good cash flow. Your return on equity is going to be much higher than what you're getting from an apartment, and you have nothing to do for 15, 20, possibly more than 20 years.
The unrealized equity, we'll probably touch on that.
Yeah, so
In apartment buildings, a lot of people think you're getting a certain return, certain cash flow. A lot of people don't realize the unrealized equity that's locked into your apartment buildings. So you have to look at what the value is today and do that calculation. You may think you're getting 8-10% return. The return on your equity could be 2, 3, 4% in current market standard. So you have to take that equity and place it. You'll see the true return that you're going to get.
it's very often, because I'm looking at people's tax returns, people say I'm making $40,000, $50,000 a year on my apartments. And I go through and I look at what they've actually done, because they're doing improvements, they have turnovers, whatever. You've made $20,000 in 3 years on this property, adding back your depreciation. You think that this apartment is doing well for you, but there's always something that you're upgrading. Someone moves out, you want to put in new flooring. Someone moves out and you have a vacancy for a month and you're busy and don't get to it right away. That sort of stuff happens, and you miss out on a lot of that. And like Kevin was saying, you're missing out on what your cash flow really is. The perception is that it's doing a lot better than it usually is. And I see people's tax returns when they throw in everything or see their operating statements, their bottom line number of what they actually made is not what they're hoping to make on that transaction or that particular property. Other questions?
Thank you very much. I'll touch on that just real quickly about the unrealized return. So, I had a client that had an apartment building in Bellflower, and when I talked to them about trading up or trying to get into triple nets, they said, "Oh, this is a cash cow. Why would I ever sell this?" I was like, "Well, that's great. I wouldn't sell it either if it's a cash cow." And I asked him about how much he made a year on the property. He said, "Oh, I make about $20,000 to $25,000 a year. That's I don't have to replace a roof or anything big or have any major, turnover, expenses, or, someone's out of the unit for a long period of time." We're like, "Wow, that's awesome. How many units is it again?" And so we started talking about the value of his property, and it was worth over $1 million. I said, "Do you realize that you're making about a 2% return on your money?" He's like, "Oh, wait, I didn't think about it that way." If you take $1 million and you moved it into a triple net, and he actually tripled his income, and he didn't take any debt on it. So it's just that kind of when you start looking at it like that, and what is my equity in my apartment building, and what can it really be earning me if I put it somewhere else? Just an analysis that you need to take a look at. Next speaker, Greg Burns. Greg is with IPX. He is the Senior Vice President. It's a subsidiary of Fidelity Financial, and he's a national leader in the 1031 exchange services. He has over 17 years in the business. He has assisted thousands of clients and tax advisors. His extensive knowledge in all types of exchange transactions make him an invaluable asset to his clients in this panel. Thank you, Greg, for coming.
Sure. So nothing like talking a little taxes right at the end of the presentation to really get you guys to sleep, right? So Kevin's a little bit modest. The real estate in dealing with the net lease side is pretty complex, right? Because you got to underwrite the company, you got to look at the lease, and there's lots of things that are involved. You look at obviously the location of where it's located, and there's a lot that goes into it. So if you don't have something, to give you guys a rough idea, our company does about 2,700 exchange transactions per month. We turn over about $3.5 billion of exchange funds, so we do about $10 billion in transactions about every 90 days. So we're seeing lots of people like you move out of the apartment market into the net lease market. And we see a fair amount of people who are, experts in the apartment market, kind of self-proclaimed experts in the net lease market. And that's just not the same thing. And so it's important that when you make that transition, that you go with somebody that kind of understands that process. I had a good exchange story with a net lease deal. We had a client that sold a nursing home facility for $22 million. And so I met with her, her and her husband, probably about 6 months before it closed. And they said, okay, yeah, we're gonna exchange. We wanna go in. They didn't even know net lease existed. And so I talked to them a little bit about net lease, and they said, yeah, we want to go in that direction. And then about 2 or 3 weeks before the transaction closed, I got a call from somebody within the organization. They said they decided to just pay their taxes. I said, dear Lord, why would they ever want to do that, right? So I called an emergency meeting with the client. I had the client there, the CPA there, the financial advisor there. And I said, okay, how much are you going to owe in taxes, right? This is a portfolio that they had been building since they were kids, back in college. And they started out with buying homes around Caltech in Pasadena. And their tax liability was about $8 million on this $22 million, right? And her husband was really adamant about this. I'm going to take this money, I'm going to pay my taxes, and I'm going to go invest this money into the stock market. And I said, well, why don't you do this? Why don't we go buy $22 million worth of net lease assets? And they had about $1 million of debt. And then after you've completed that transaction, why don't you refinance out Kevin's magical number, 50%. So you have a 50% loan to value. You now have $10 million and you have $22 million worth of net leased investments that are making cash flow for you. What are you risking? How much money were they actually risking by doing that? $2 million. They would have ended up with $2 million more if they would have just sold and decided to pay their taxes. So with this $2 million of more money, they got $22 million worth of net lease assets that are all on long-term leases, that all have long-term financing, and all of them, the one thing that they, wasn't mentioned here today, a lot of those deals that they showed you, or a fair amount of them, they're actually getting positive leverage. So the cap rate is, let's say, a 5%, or maybe it's 4.5%, and their loan is at 4%. And so they're actually making money technically, right, on the money that they're borrowing from the bank. So let's talk a little bit about 1031 exchanges. So the Internal Revenue Code Section 1031, exchanges have been around for a really long time. They started actually in the 1920s, and over the years they've kind of evolved. And there's a famous case, has anybody ever heard these referred to as a starter exchange? So there was a famous case in 1979 where the guy by the name of John Starker sold off some timberland and then 2 years later exchanged it for some commercial property. And at that time there was no Section 1031, there was just case law that people were relying upon in order to do their exchanges. Well, the IRS challenged him, they went to court, and he won. And it's probably one of the most famous cases within Section 1031. So now they've got a situation where they've got this guy that sold property and then 2 years later bought other property. And so they finally decided to come out with some regulations so that people could feel comfortable doing these without worrying about getting attacked by the IRS, and the IRS is not going to court and losing cases. So in 1986, they came out with Section 1031, which allows somebody to sell a property that they've held for investment or business use and exchange it for another property that they intend to hold for investment or business use, with the ultimate goal of deferring the payment of capital gains taxes. It's really one of the last great tax vehicles that exists. But the interesting thing that you'll notice up there is it says exchange of property held for productive use or business. It doesn't say real estate. So we exchange all kinds of things, right? So we exchange corporate jets, lease cars, artwork, livestock. I recently exchanged a racehorse. If we've actually come to the point where I've figured out, the only thing I haven't figured out how to exchange yet are husbands and wives. And if I can figure out that, I'd probably be in great shape. Yeah, you figured it out? Oh, good. Someone told me there was a website for that, but I thought that was probably a different topic. So, Section 1031, such a great tax deferring tool that actually last year, where the government's really hot on tax reform. And so it was mentioned actually in 3 tax reform proposals last year. The House Ways and Means Committee came out with it, and they said, listen, we should do away with Section 1031. There was $34 billion deferred in taxes in 2013 for these people doing exchanges. This is just, allows the rich people to get richer, right? And then there's a senator that came out with some stuff on tax reform, and he said that we should eliminate it as well. The president even mentioned it in his budget, saying that we should at least limit the amount of gain you could defer in a single tax year to $1 million, right? Well, the problem with that study that they did was it was a static study. So it didn't take into account what investors might do if 1031 didn't exist. So we went out to Ernst & Young and we did a macroeconomic study that showed, okay, what would happen to the real estate market if 1031 didn't exist? I mean, it'd be pretty tough, right? If I was Steve and I came to you and I said, listen, here's what I want you to do. I want you to sell your property. I want you to pay taxes. I want you to pay my commission, which is not very much, and I want you to go buy more real estate. How's that sound, right? You go, wait a minute. I gotta make it back to, I got 30 to 35% before I get back to break even. Why would I do that? And so the consensus showed, and the Ernst & Young study showed, that we would basically shrink the economy by about $8 billion a year. And so we took that report, to Washington, and we spent, a lot of time trying to educate some smart and some not so smart senator and congressman out there about the 1031 process and why it needs to, not be put into a bill. So we spent a lot of time making sure that hopefully that stays around for many years to come. We think it's a revenue neutral type of code, but and hopefully we've kind of got that across to them. So we'll go on to the next slide here. So kind of what happens in a taxable sale of real estate? You've got the federal capital gains tax rate, it's 15%. They break it up. So the federal government, they say on the appreciation of your property, we're going to make you pay 15% on the first $400,000 if you're single, or $450,000 if you're married, and anything above that, we're going to make you pay 20% on. But any depreciation that you've taken in the property, we're going to make you pay 25% of that is back as well. So the federal government breaks it up between appreciation and depreciation. The state, however, they just lump the two together, right? So the state says, okay, your property's gone up, well, yeah, the old affordable health care tax. You could get paid on, could get hit with that as well. But the state of California, they lump the two together. They say, okay, your property's gone up, $1 million in value. You've taken $200,000 in depreciation. We're going to tax you at whatever your income level is, which is probably going to be 13.3% because you've got to report it on your income tax if you sold the property. We're going to tax you, at 13%, 13.3% on that 1.2 million. That's right. So the other thing that people don't understand when they sell real estate and go to cash out, they see these basic taxes on the front end, but what they don't realize is that since they have to now report the sale on their return, that certain deductions start going away. My dad was about, I guess 20 years younger than I am right now. He went to his accountant and he said, listen, how do I get more deductions? And his accountant said, have more kids. And so there's 6 of us, right? So he did a good job with that. And somewhere down the road, he went back, maybe about my age, he went to his accountant and said, how can I get more deductions? I feel like I'm paying too much in taxes. His accountant said, well, get a bigger mortgage. And so we got a bigger mortgage. Well, once you start making over a certain amount of money, it tells you to turn to page so-and-so, and will tell you how much of Greg you can write off, right? And it's the same way, with the interest on your mortgage and certain deductions you can take since you have to report the sale on your tax return. It could theoretically, put you into a much higher tax bracket and start taking things away from you. So, the one thing I will say about paying taxes right now is that capital gains federal tax rate is as low as it's been in a while, right? So we've seen capital gains tax rates, for a lot of you have seen them 20%, 25%. They have been as high as 28%. So, they lowered them to 15%, it was like in 2000. And I remember I was in Palm Springs, and one of my clients called me and they said, I'm not going to complete my exchange, I'm just going to cash out. And I'm like, what? He's like, well, I'm getting a discount on my taxes. They just lowered it to 15%. And so when they lower taxes, capital gains taxes, what is that designed to do? Generate revenue, right? People say, oh, I'm going to get a discount on my taxes, so I'm going to sell. So, federal capital gains tax rates, for the most part, are about as low as they've been in a long time. So these are some of the reasons people use to do exchanges. Obviously, people use it as a wealth building tool to increase cash flow, reduce operating expenses, reduce risk, less management incentive. Some people are doing it to consolidate. We're seeing a lot of the baby boomer generation right now. They're getting tired of the terrible T's of real estate, the tenants, the taxes, the termites, the toilets, all the fun things that are associated with managing property. And looking for more passive types of investments. And typically, when you have people that own maybe smaller type properties, maybe 2, 3, or 4 units, the amount of equity that they have in the property versus the amount of cash flow that they really get is typically pretty low. It's like 1.5% to 2%. And so they can kind of unlock that equity, like Steve was talking about, and put it into an asset that actually gives them the actual return that they think they need. Also, another thing that we're seeing right now, especially in California, we're running into some issues with it, is they're trying to separate their estates, right? They're at a point in their life where maybe they have, I've had a meeting with a gentleman and his wife, I think it was about 2 months ago. And his partner in this deal just passed away. And the partner was very friendly with his wife. But the wife that was in the room was like, she can't stand me. If something happens to you, this is going to be a nightmare, right? So we need to start separating our assets. And it used to be pretty easy to do that. You just kind of drop into tenants in common, and then maybe you'd sell an asset or you'd swap it. The state of California, the Franchise Tax Board, is really looking closely at those transactions. In fact, they've actually changed something on the partnership. They've added a box on the partnership return form to try to find those types of transactions where you're in a partnership and you deed out of that partnership and into tenants in common, and then sell and kind of go your separate ways. There's a box that now asks you, have you deeded out of a partnership and into tenants in common within the last 12 months? And then the next box asks you, have you done a like-kind exchange? And the Franchise Tax Board's position on that is, listen, we know that the partnership held the property for investment. But we believe that you guys, as individual tenant and common owners, held the property primarily for sale. And properties that are held primarily for sale don't qualify under Section 1031. Does anybody know why, under 1031, why they put that clause in there, that properties that are held primarily for sale don't qualify for 1031 treatment? Any ideas? Well, primarily for developers. Because otherwise, developers would just never pay taxes. They would do a development, sell it off, do a 1031 exchange, buy another development, build that, sell it off. Now, can anybody tell me how long you have to own a property before you could sell it and do a 1031 exchange? So if Bogie sold you a property, let's say 3 months ago, and today he came in, met you before you came in here today and said, listen, I got this guy that really wants to buy your property and he's willing to pay you a lot more than I sold it to you for. how long would you have to hold it, or could you at that time accept the offer and maybe do an exchange? What do you think?
2 tax years.
2 tax years. So the rules, we talked about it in the very beginning. They just say that your intent when you purchased the property had to be to hold it for investment. There is a revenue ruling out there that says any property that's held for 2 years or more, they won't challenge it. That revenue ruling is not specific to that kind of transaction I'm talking about. They put that revenue ruling in place because people were doing 1031 exchanges and were going and buying their dream home, which is fine, right? So I sell my apartment building, I go buy this dream home in Hawaii, right? I rent it out for 2 years. I decide, you know what? I'm going to retire in Hawaii. I kick the tenant out of it, I move into it, I make it my primary residence. Guess what? I've held it as an investment for 2 years or more. They can't challenge it, right? But when we're dealing on the investment side, it's not quite as clear. In fact, I had a client one time hold the property for only 7 days and did a 1031 exchange. So he's a lawyer, he sold the property, was in an exchange, he found an office building in Pasadena, he put it under contract into escrow for $2.4 million. In escrow, he got an unsolicited offer for $3.2 million, $800,000 more than he had it under contract for. He called me up, he said, "What do you think?" I said, "Well, you're a tax attorney, why are you calling me?" He said, "Well, this guy's way overpaying for this property. I'd like to sell it because if I, sell it for that price, I can get something that's a lot nicer." So I said, "Well, was your intent when you bought it to hold it for investment?" He said, "Yeah, I'll move my whole office there." I said, "Okay, well, let's do it." So he buys the property, holds it for 7 days, sells it to this new buyer, which is actually a funny story that we don't have time for, but, and then does a 1031 exchange. So 2 months later, I get a call, his name's Gary. He calls me up, he said, "Greg, can't sleep." I said, "Why?" He said, "I'm worried about this exchange. I'm just worried about that they're gonna audit me and they're gonna disallow it." And I said, "Well, what do you want to do?" He said, "I want to get a private letter ruling." I said, "Oh, you don't want to do that. Please tell me you don't want to do that." So a private letter ruling, basically what you're doing is you're going to the government and blowing the whistle on yourself. So you're saying, "Listen, here's what I did. Tell me that it's okay." I'm like, "We can do that if you get audited. Let's not do that now, right?" So he said, I got to do it. I just got to know if I got to pay my taxes. I just got to know. So he got a private letter back from the Internal Revenue Service that said, "Listen, we believe that you bought it with the intent of holding it for investment. You're not somebody that's buying and selling properties. You didn't market it for sale. And so we think that it works and it's fine." So there's a kind of an interesting story about somebody that held the property for a short period of time. So let's see what else we got up here in the slides. Estate planning. So it's a good estate planning tool. People tell me typically when they say, "Listen, I just want to sell my property, pay my taxes, and put the money in the bank, and so it's there for my wife," because we never outlive our wives, right? So it's there for my wife when I pass away. I always tell people, listen, you can leave them a lot more money by keeping your money into real estate. Because essentially when you pass away, you get a step up in basis equal to the fair market value at the time that you pass away. I call it the swap till you drop program, right? You just keep exchanging throughout your lifetime. When you pass away, your heirs receive a step up in basis. So this is kind of an interesting example of a deal that we did that, I know it looks like a big house, but it was actually a huge office building in El Segundo. They sold this huge office building in El Segundo, and he was like, "I'm just going to cash out and pay my taxes, and because my kids, they don't get along, and I know that they won't be able to manage this building by themselves, and it's just going to be a mess." So I said, "Here, that's what you do. We're going to sell this building, and we're going to do a 1031 exchange, and you are going to tell each kid how much money they have to spend on the property." He said, "Wait a minute, I'm going to let my kids choose their own property. These guys are millennials, they don't know anything, right? And I said, listen, they have to choose their own properties, because guess what? If you choose 3 properties, one of them is certainly going to outperform the other 2, right? And so then little Johnny's going to be like, oh, that's no fair, he got a better property. And so he did. He let them each choose one property, and then the trust bought 3 properties. And when he passes away, each child's going to get their own property, and if their property underperforms, guess whose fault it is? It's the kid's fault, he picked the property. All right, move on. We'll move past that. I think we've already talked a little bit about that. Diversifying, obviously it's a great thing to have, Los Angeles, it's interesting to me. My brother lives in Florida now, and he said, and a couple months ago he called me, he said, there's a hurricane coming. And I said, man, I just don't know how you live in Florida. You have these shutters you got to put up on your windows, and it's crazy. He said, I don't know how you live in California with those earthquakes. I'm like, when's the last time you had an earthquake? He said, oh, it's coming, right? So, the idea is, if you have a lot of money tied up in a single asset, it gives you an opportunity to sell. The net lease, 12 years ago, if I would have, somebody would have called me and told me about net lease, I would have had no idea what they were talking about, right? But we do see a lot of people taking that money out of a large asset and diversifying it across the country, right? So they've got different product types, different locations, so they're not subject to, potential, we owned property in Northridge during the Northridge quake, and it was, a hard time to get through. So this way it kind of diversifies, spreads your risk a little bit. Moving on. What to look for to QI. All exchange companies aren't considered equal. We're wholly owned by, Fidelity National Financial. They're, triple B rated, publicly traded company. So you just want to be sure. Our industry's unregulated. You don't have to be licensed. You don't have to be bonded. So it's really important that you just don't go with like Joe Blow's exchange company down the street. There are other companies out there that are like ours that are very good. We think we're the best, but certainly don't use, Johnny's, exchange company. And I think we're getting close on time here. Ooh, I'm right on time. So we're going to kind of bypass these slides. I'm a little bit like Kevin. I don't even use PowerPoint presentations ever, so I kind of go off the cuff. Are there any exchange questions that you guys have? You guys have now all become kind of expert exchanges, right? I'm not going to get any phone calls saying, oh, yeah, just one question. Well, yeah, go ahead.
We got a question about the, I'm sorry.
Go ahead.
We have a question about what amount of money from a sale do you have to put into the 1031 exchange? Is it just the gain on what you?
Right.
We're talking about.
Yeah. No, I
we've already had one.
Right.
And we're going to have to sell another one.
Right.
That first property we sold was the first exchange. Now that's for exchange number 2.
Right.
So
right.
You have to put
so
the sale of number 2 into number.
So the question is, if I sell a property, do I have to move all the equity? What do I have to buy? And the answer is, in order to complete an exchange and not pay any taxes, you've got to do 2 things. You've got to buy something that is equal or greater in value to the net sales price of the property that you sold. And when I say net sales price, it's net of real estate commissions, escrow fees, title insurance fees, any reasonable and customary non-reoccurring closing costs. Right? So if I sell a deal for $1,550,000 and there's $50,000 in closing costs, I got to go buy something that's $1,500,000 or greater to not pay any taxes. I also have to reinvest all of the proceeds that I receive from that sale into the new property. Now, I can take cash, but I'm going to pay taxes on it, right? So if I take $100,000 from the sale at the close of escrow, I'm going to have to pay taxes on $100,000. And maybe I find a deal. Kevin comes, I've got to spend $1,500,000, and maybe Kevin finds me a deal that I love, and it's $1,450,000, right? And because he can negotiate me a really good deal on it, I can still do an exchange. I can still defer taxes. I'm just going to pay taxes on that difference, right? That $50,000 difference, which isn't necessarily the end of the world. So you know, the most people think like, I've got to get a loan that's equal or greater in value, right?
Right.
So, but that's not really a rule. If you comply with the first two rules, the third rule just works itself out, right? So if I buy something that's $1.5 million or greater, I reinvest all of the proceeds that I get from the sale. I'm either going to get a loan that's, you know, equal or greater, or I can offset that loan with my own money. So if I come in with additional cash, I can reduce my loan amount. Now I can't just buy something for all cash, because if I did, you know, I wouldn't be replacing, you know, what I sold at value. So if you stick to those first two rules, the third rule just works itself out. Yeah.
If you're exchanging for two properties,
Yes.
how do you deal with how much you finance?
Well, I mean, that's a good question. Like, so the question is, you know, let's say I want to diversify. I'm going to sell one property and I'm going to buy two. How do I figure out, you know, how I'm going to break the financing apart? Now, we have some people that say, listen, I'm going to buy this first property all cash, and I'll get my additional financing on the second property, and then maybe I'll take a little bit of cash and through a refinance out of this first property, and I still have good loan to value on it, right? That's something that we've had to. We actually had a client one time that had like, you know, a lot of money. It was like $42 million, but it was an $85 million exchange. They had to buy the first property because they were competing for all cash. So they basically used all $42 million, had to refinance that in their exchange period, and then use the money to go buy the second property. So very unusual, but it happens. Huh?
So if you decide to sell multiple properties that are owned with different entities, and then you go to place offers for your outlet,
Yeah.
do you have to, is the offer and the purchase agreement have to be in that entity's name that you're going to close with, or can that change? And is the most important thing is which entity closes the offer?
The most important thing is always the taxpayer identification number, right? So if I own a property in an LLC and I'm the sole member of that LLC, the LLC is disregarded for tax purposes, and I'm the taxpayer, right? But if Steve and I own a property together in an LLC, well then Steve and I don't own real estate. We own an interest in a partnership, and the partnership is the one that owns the real estate, and that's who the taxpayer is. So it really kind of depends on if you've got multiple, you know, properties that are owned by different entities that all have their own taxpayer ID number and all file their own returns and all issue K-1s, then you might be in a situation where you have to take title as multiple tenants in common. It really depends on the particular deal, and you have to break each one of those entities down to make sure that you're, you know, we can eliminate as many as you can.
Maybe I should ask you this after the session, but I'll try one more time. If you own a property with Steve and you own a property with John,
Yep.
and they're both in exchange, you sold both of them. Now you're out there looking for property to purchase. If you place your offer under the property that you own with Steve, and the purchase agreement is with that entity as the buyer,
Yep.
can you end up closing with the entity that you own with John?
Sure, you just write and or signee. So, and you just
So
sign.
as far as the 1031 rules, it's okay?
No.
As long as you close?
They're two different taxpayers. So the entity that Steve and I are in is one taxpayer, right? If Kevin and I are in another entity, that's a separate taxpayer. It's like a completely different person. So if our entity sells, right, the entity that's Steve and I, that's the entity that has to acquire. I can't acquire in an entity that I own with Kevin, because it's a completely different taxpayer. It would be like me selling a property and you buying a property, and I told the IRS that I did an exchange. You'd be like, no, you didn't. You sold the property, you never bought a property, right?
I'll catch you afterwards. Thank
Yeah.
you.
Can you sell,
We can sell anything.
but does anybody, can it be a family member? I mean, does the IRS, does any?
So there are special rules to dealing with related parties. You can sell property to a family member. You can. There are certain restrictions that come with it. And you can, like take my card and call me and I can send it to you. There's a subsection within 1031 which would put everybody in this room instantly to sleep. And so, as an effort to value your time, we're going to kind of wrap this thing up. I will tell you, I've been doing business for 17 years. I deal with a lot of real estate companies. I deal with a lot of publicly traded REITs. And I can tell you that the people that were here talking to you tonight are some really the best in the industry, and I really truly mean that. It's not a sales pitch. And if you need help or you have questions, you've got a tremendous resource, at least within these couple of guys here. So thank you guys for coming, and we'll turn it back over to Steve.
All right, thanks a lot, everybody. I know that we went a little longer than anticipated, but hopefully you guys got a lot of information out of this. Hopefully it was beneficial to you. The triple net lease properties are not for everybody. If it is something that you guys are interested in exploring further, let myself know, or whoever invited you, the guys in the back. We'd love to take the next steps if it's something you want to do. We do some return on equity analysis, obviously valuations of the properties that you currently own, and then bring Kevin and his team in early on to start talking about what direction you want to go into. So with that, thank you. Thank you guys for all the speakers, for Tech or Title. A couple things before you go. There is, if you park right out here, if you just mention the Bogie Investment Group or Marcus Millichap, the parking will be paid for, so don't worry about that. And have a great night and drive safely.